Welcome to ETF Market Insights, a weekly show focusing on the evolving world of ETF investing. Each Friday, a new panel of thought leaders aims to provide investment education and insights, with the goal of helping you become an informed investor. Make sure to visit youtube.com/ETF Market Insights to watch previous episodes. And remember to hit subscribe so you receive a notification when we post new content and when we go live each Friday. Thank you for joining us today. Let's get started.
Welcome back to ETF Market Insights. I'm your host, Erin Allen, VP of Online Distribution with BMO ETFs. I hope you enjoyed our special edition Spring into ETFs content over the past couple weeks. We are back to our regular scheduled program, starting off fresh, a new season this week. I hope you like the new format, so comment below if you like it. We'd love your feedback. One of the episodes last week on Spring into ETFs was on ETFs to help manage risk in the current environment. And I think it's a topic that we could have gone a lot deeper into on one idea in particular, which is low volatility ETFs. Today, of course, we're facing all kinds of different uncertainties and risk factors in the market. We have the US debt ceiling, continuation of the war in Ukraine, inflation, US banking issues. You get the picture. So I think investors who want to stay invested over this time period of higher volatility might be interested in learning more about our low volatility approach and how that can work in portfolio construction. As always, a quick reminder today, we're not providing you any advice or investment recommendations. Our show is all about providing education to individual DIY investors here in Canada. So today I'm joined by Chris Heakes, portfolio manager of our BMO Low Volatility ETFs. Chris, you've got over a decade of experience in managing equity and derivatives-based ETFs for investors. And you're definitely no stranger to the ETF Market Insights channel. So welcome back.
Thanks, Erin. Good to be back. And one of my favorite subjects as well, low volatility investing.
Yes, good to have you. So let's dive right into it then, Chris. For a closer look at these solutions, can you just explain as sort of an intro what are low volatility ETFs and how do they work?
For sure. So low volatility, it's part of that factor-based investing, or smart beta is another term you might use. I think it really came out of the financial crisis where there was a lot of risk in the markets, and the experience and kind of memories that left on people is they wanted to find a way to get equity exposure, but not expose themselves to as much risk as they had just gone through in the financial crisis. Really what it comes down to is investing in more defensive-based stocks, more defensive industries. At BMO, we measure the risk of stocks using a metric known as beta, which measures the relative risk of a stock versus the index. So again, looking for lower risk stocks, and can really provide two key benefits. First benefit is, when the market's very volatile, there's a capital preservation benefit where they tend not to go down as much as the market. In some cases, they can actually perform quite well, even if the market's quite volatile. And the other kind of nice aspect of it is there's something to be said for the sort of slow and steady approach to investing. So, when you look at kind of quote unquote boring companies, they can actually be pretty good return generators over the long period as well. Often investors are chasing returns. They want to make, double your money and quickly. But, if you take a little bit of a more, prudent, laid back approach, look for high quality, lower risk stocks, they can actually do quite well on the return side too. So that's really what low volatility investing can help investors with.
Yeah, totally. It's that win by not losing approach. And if you can avoid some of these downturns, then you're in a better place as we come out of it, right? The approach isn't new. It was popularized and came out, a bunch of studies came out in the early 70s. But what are the different approaches or methodologies that are available out there? Like, how do we actually measure how volatile a stock is, and what's your favorite approach?
Yeah, so there's, I'd say, kind of two main approaches. And it goes for low volatility investing, or really any factor or smart beta, like a value strategy or a momentum strategy or what have you. There's some strategies that start with your benchmark. So think of your TSX for Canada or S&P 500 in the US. and they move a little bit, tilt a little bit one way or another, but they kind of still hug the benchmark a little bit. And I would put, perhaps optimization approaches somewhat can fall into this bucket. And, they can be good, but one of the things is if you really want the benefits of the lower risk stocks, you do have to be willing to look different than the index. If you look like the index, you have index like return. You have to be willing to look a little bit different, and that's where metric approach can be beneficial. So I would call this more of a pure approach to constructing a portfolio. The first approach that came in the market, the first low vol ETF, was launched in the US, launched by Invesco, and it was a 1 year standard deviation as a metric. And standard deviation is a measurement of just how much variability are their returns on a daily basis. Lower is lower risk, higher is it means more variability. So it looks for stocks with less variability. When we launched at BMO, we launched the first low volatility ETF in Canada. We launched it a year after that one in the US. And first ETF or fund strategy that I'm aware of, actually, in the low vol space in Canada. What we did is we looked at volatility, but then we looked at different ways of doing it, different metrics. And what we ultimately settled on, and as my preferred approach, is beta that I mentioned, but more importantly is taking a longer time frame when measuring that beta. And that can be important because, as we know in markets, things are changing in a year-to-year basis. Sometimes you find what's not risky in 1 year can actually become risky in another year.
Right.
Great example of that could be REITs. REITs before COVID were a very low risk sector, all in all. But during COVID, when obviously there were significant things happening, they became a higher risk sector. But you want something that's going to smooth it out, and that's why we went to a 5-year beta. And it's really proven to be an effective way to screen for these companies.
All right, that's good to think about standard deviation versus beta. Oh, so you were on the team that helped create these ETFs. So there's definitely some misconceptions around low volatility investing that you probably had to battle through. It's just a fad, or you're going to get lower performance. What would you say around some of these misconceptions?
Yeah, well, I think it's true to an extent. The genesis of the factor came from wanting to avoid risk. And but what kind of happened, and as people begin to realize, is, again, we'll go back to this real concept of what we call the low vol anomaly. And what that's all about is when you look at the history of stock returns, and there's been a lot of academic research, we look at stock data going back 100 years or so in the US. And you would think lower risk stocks should give you less return. And if you take more risk and go into higher risk stocks, you would think you would be rewarded with high return. What the low vol anomaly is all about is actually they find that, when you actually test out that theory, that hypothesis through time, it actually doesn't work. So that's the kind of the startling result is lower risk stocks can actually give a better risk adjusted return than higher risk stocks. And again, I think, and they call it an anomaly because it's not really fully understood or explained. But I think the best way, and the way that I think about it, it makes sense to me, is, again, that investor, not every investor, but many investors' preference for over pursuing high risk stocks. And when you're putting too much attention on high risk stocks, that lowers the forward return because there's too many dollars chasing it. But then on the other hand, those lower risk stocks are getting relatively ignored. And that means there's not enough money behind those. And that increases the forward returns of lower risk stocks. So yes, certainly risk was where it came from. But over the years, I think they've proven that they can, over market cycles, deliver very good returns, sometimes, better returns than the index even.
Yeah, and
As
we'll,
we have with the
we'll show
ZLB
some
in
charts of
Canada.
that too. We got
Great.
the charts coming, Chris.
Perfect.
What's the real benefit to investors then, like from a financial planning perspective, that this type of product can provide?
Yeah, well, again, I think the textbook kind of use case would be, your older investor, maybe closer to retirement, maybe in retirement, who still needs some equity exposure and equity growth to, meet their financial planning goals, but it, is more sensitive to those downside outcomes that can happen from time to time in equity markets. So that's your classic use case, someone who can get equity growth, but just be mindful of the risk. And if things don't go so well, then then they have, hopefully a little bit of relative protection versus, broad indexes.
Yeah.
But, again, to the point of, it's proven that, or at least historically with, say, the ZLB, for example, you haven't given up on return. It can be used by all investors, I think, even investors with longer time horizons, and it can help them on the risk side and potentially help on the return side as well.
I think it also ties into this whole behavioral finance and the theory of loss aversion too, where the psychological pain of losing is twice that of gaining, and that can make people do a lot of funny things when they get scared of what they're seeing in the markets. And I think a low volatility approach can help that with that emotional bias as well, and helping them stay invested through these times for sure. Okay, walk us through some examples of our BMO low volatility ETFs. And you already mentioned the low volatility anomaly, but how have these performed? We've got the charts here to show.
Yeah, so I mean, let's start with the Canadian, the ticker ZLB, the BMO Canadian Low Volatility ETF. If you look at it versus the index or even some other low volatility ETFs, it's done very, very well. One of the main things in Canada is you think of where does volatility come from in the Canadian market. Usually it's from energy and materials, and energy will have, they will knock it out of the park on the occasional year. 2022 was one of those years. Energy had
Yeah.
very strong return. But, unfortunately, you look at the long-term track record, it's just not consistent enough. And you do have years where it goes sideways, years where oil went from 100 to 30. I think that was in around 2015, 16 or so. And then, during COVID, oil went from 30 to negative, right? So you have very challenging environments. And so, the low vol approach in Canada, that's one of the key ways that it's add value. It avoids some of that volatility. To your point, winning by not losing is very important. If you don't have those drawdowns, that means you don't even have to do as much to be successful. You just have to, not make mistakes. And that's what it's about. And, some of those kind of more boring companies in the portfolio, think about grocery companies, utility companies, Dollarama is a company in the strategy, Waste Connections, which is garbage disposal and recycling. Listen, these are things that everybody in our society needs, regardless of what's going to happen. So, they can
Yeah.
prove to be good investments over time, and I think that showed in the performance.
Yeah, the Canadian performance is amazing. Are there regions where, like, I guess Canada would be one of them, but are there other regions where this approach does better or adds more value?
So it really, really the low vol approach, I think, adds a lot of value in cyclical markets like Canada. If you look to a market like the US, it adds value, not as much. We haven't had as much return outperformance, but we've had similar return with our ZLU, the US strategy, as the S&P 500, but we have reduced the risk level.
Yeah.
So one thing you'll see there, if you look at, performance on that one, um, you know, being underweight volatility in the US generally means we're going to be underweight tech because tech's a more volatile sector. Now, if you look at
Right.
tech has been having some wild runs, in the last 3-4 years. It had a very, very strong performance through COVID. But then when interest rates started going up last year in 2022, the NASDAQ was down, I believe, 30%. Now to start 2023, the NASDAQ saying, don't forget about me, NVIDIA, we've got this AI euphoria, tech is back up again. So what you see in the US is that index is very heavily tech influenced. So the low volatility, again, it's underweight that. Tech's delivered some strong returns. Let's not, we can't take that away from the sector. But what low vol's been able to do over the long term is give a similar return as the index, but again, take out some of those bigger swings, and that can help investors who are trying to manage risk.
And you touched on this already, but are there other ways that you've seen it, like with the retirement play sort of thing, but are there other ways that you've seen investors use these ETFs in their portfolios?
Yeah, so like I said, I'm and perhaps I'm these strategies are very close to my heart, and having managed them for 12 plus years now. But so I think all equity investors can use them. But just to maybe go back to that tech point, how do you build a portfolio? Some investors may want more low volatility, some may want less. But US, that's a good example where one trade or one idea that we found has worked very well is pairing a low vol with a NASDAQ. The NASDAQ can benefit from the growth and, this kind of technology story that seems to be no end in sight in terms of where that's going and the growth that's going to be there, but pair it with a low vol. And now what you can have in a portfolio is something that's going to benefit, whether the economy is slowing down or whether growth is heating up. That pair can be really effective. So that's one pair where we've noticed a real benefit. That
Sort of that
investors
barbell
can consider.
approach. Yeah.
Absolutely. Yeah.
I think a more advanced, we did a session with Alfred a few weeks ago on advanced portfolio techniques, and others use it in sort of a factor rotation type strategy where they'd rotate into times of stress into that type of factor. So there's all different kinds of way. Like you mentioned, buy and hold it for life. It's a great, great portfolio, but so many ways. Are there risks that we should highlight, or what are sort of the considerations that investors should look at when thinking about low vol ETFs?
Well, I guess if you think about when does it tend to underperform, and every factor, smart beta, will have periods where it's not as in favor. There's a couple things I would say. One is, a market where things are just rallying indiscriminately. So some people might call this a junk rally, or just a really strong bull market where it doesn't matter what you're in, but things are going up 20, 30% a year. In that type of market, investors are going to embrace risky stocks. And so we have seen a few of those periods. We've seen them in the US in the past few years. Low volatility will tend to participate. They'll tend to give positive returns, but those riskier stocks will tend to have higher returns. So again, so it's not like it's not like you can't participate in the rally, but sometimes those stocks will go higher. And the other thing is, low volatility investing from a sector point of view, it's going to put you again more in those defensive sectors, less in the high risk sectors. And so what you could have is, say, a year like 2020 was interesting for many reasons, but from a market's perspective, large cap tech in the US and in Canada with Shopify, that was the only thing driving returns. There's literally the only thing driving returns and carried the indexes. So if you don't have those in your portfolio, if you're underweight, you can have a lag. So our low vol didn't lag in 2020, but still maybe didn't add as much, didn't have those securities, so missed out a little bit on that. But I think again, my preferred approach is a buy and hold through a market cycle, not think about the up and downs too much, and it tends to revert over time. But those are a couple things you could consider with them.
And talk to us a bit about how macroeconomic factors affect this factor and sort of where we are at today, and what's your outlook for low vol as we stand now?
Yeah, so I think we're all trying to figure out where we are at today, but it's challenging. But if you look at historically where we're at today, we're at near the end of a hiking cycle. There might be a couple more interest rate hikes coming, but we're getting towards the end. And if history is a guide, what tends to happen is the hiking cycle eventually punishes markets, a little bit, and can cause, a recession, whether, of varying degrees, right? So that tends to be the historical precedence. And again, in a period of economic slowdown, a defensive strategy like low vol can perform very well versus the broad index. So that would be the historical guide. There's different opinions out there, of course, in terms of we might not have a landing, the no landing hypothesis, and we just go on from here, a soft landing, a hard landing, and everything in between. But I think there are enough challenges. It feels like more in the last couple of years than there have been before. So, I think at least for a portion of equities, I'd recommend. I shouldn't say I'll recommend, but me personally, I like low vol because, again, it can take out some of the risk when things do get tough. So it can be a nice thing to have in your corner, should the volatility elevate.
We know you've got a lot of low volatility ETFs in your own portfolio, Chris. So don't worry about
Absolutely.
All right. Thanks for joining me, Chris. Actually, before we close out on the low volatility side of things, thanks for all your insights on that front. But there is one other question that I sort of wanted to tackle on today's show around covered call ETFs. So kind of switching gears here. We did see cuts in our monthly distributions on a few of our covered call ETFs, and I've seen some buzz about that in the different chats online. So I just wanted you to walk us through that and why we had to do that.
For sure. Yeah. So we'll switch gears a bit, but you know, we started the cover call industry in Canada, right? The ETF cover call industry, and we always wanted to do it the right way. I think one of the things you want to do to make it sustainable and over time. So our distribution philosophy is to A, not be greedy for yield, but B, what we generate, we're going to distribute. Now, if you look at a cover call, it's going to have two components, the dividend component of the equities, and then what we bring in from the cover call overlay. The dividends are pretty stable, and we like to focus on dividend growers for the most part, so that can grow a bit over time. The cover call is going to be impacted by volatility. So, what we've seen is volatility is still elevated compared to pre-COVID, but it's come down in the last few months. So we're collecting a little bit less premium, and we just want to reflect that into our distribution payout, because the last thing we want to do is overpay a distribution, which is something that can be, have a real negative impact for unit holders, because if there's overpayments, and quite frankly, ETFs yielding over 10%, I think you have to look at quite suspiciously, because look, equities aren't made to yield 10, 12, 15%. It's just, equities are going to have an expected return of probably of 8, 9, 10%, depending on what you're looking at. So we don't want to over distribute. We don't want to pay from Peter to pay Paul, or so forth. So we want to keep that distribution in line with what we're generating, make it sustainable, and so there's investors aren't dipping into their capital to pay their distribution bill.
Great. Yeah, I think that's consistent with what our message has been. We pay what we earn, and we're not going to be grinding the NAV like some others may be doing out there. Okay, thanks again, Chris, for joining me. Appreciate all your insights. If anybody has any questions, drop them in the chat below, or go to etfmarketinsights.com, where you can actually submit them directly to me. With that, next week, I'll be joined by the author of Lessons on Mastering Money, Fred Masters, as well as Cornell Schreiber from the Build Wealth Canada podcast. And we're going to be breaking down a number of personal finance related topics. So of course, we're going to be talking about ETF investing, but some other interesting topics as well around, should you rent versus buy? How much do you need to retire? So much more. So I hope you can all join us then. Bye for now.
Thank you for watching this week's episode of ETF Market Insights. To stream any previous episode of ETF Market Insights series, please visit youtube.com/ETF Market Insights. Remember to hit subscribe and sign up for alerts so you know when we post new content. Also, we invite you to visit our accompanying website for ETF tools, education, and much more at etfmarketinsights.com. Once again, thank you for watching. The session provided is for information purposes only. Any reference to a particular company or product is for illustrative purposes only and should not be considered as investment advice or recommendation to buy or sell. Particular investments and/or trading strategies should be evaluated relative to the individual's investment objectives, and professional advice should be obtained with respect to any circumstance.